Interesting that you had a recent revision, right, where your outlook for the property market has basically changed. It was stable just 4 months ago, now revised negative. What's changed in your eyes?
Oh, thank you, Yvonne, and thank you for having me. Yes, we did just change, our sector outlook for property sector. This obviously, has something to do with our expectation of the contracted sales. That's the key reason behind the outlook change. At the beginning of this year, post-COVID lockdowns, we actually did see some very notable rebound of both economic growth and also national contracted sales, and we had then expected contracted sales to stabilize for this year and then to come slightly above 2022. But entering into June in the past several months, the rebound has been losing steam clearly, and it's now much weaker than we previously expected. A couple weeks ago, our in-house GDP forecast for China's growth next year was actually lowered to 4% from 4.5% previously, and that's reflecting the weakening momentum of economic recovery post zero COVID policy. And obviously, slowing economic growth and income growth would have a negative impact on household spending and households consumption, and housing as the largest ticket item for households. So against this backdrop, we're not optimistic that we'll see a notable or sustainable rebound of national contracted sales from where we're standing at. We now expect it will continue to decline for the next 6 to 12 months, and driven largely by economic uncertainties and also home buyers sentiments on income and employment prospects, and all of these factors would weigh on households' spending appetite and housing demand.
Right. Kelly, David here. So that's one part of where some of these developers get their funding source. What about the other side? Some of the measures that the government's tried to introduce to plug some of the funding issues. What do you make? Where are we in that conversation?
Yes. Well, first of all, we think, the policies that we've seen in, recent policies, we think that is a significant policy shift from the government to boost property demand. This is very different from, what we've seen since end of last year. There were 16 measures, the so-called 16 measures, trying to ease the funding risks for the developers or alleviating their liquidity pressures, for the developers, but not so much on housing demand. And this round, it's about lowering funding costs for home buyers. So it's clearly more, focused on the demand side. And also, these policies to lower down payment ratios or to broaden the recognition of the first-time home buyers, so that they would be eligible to have a lower down payment ratio, and then eventually lower funding cost. And these are the policies that have been rolled out from the central government level, rather than previously. I think in the majority part of last year, what we've seen has been one city, city-specific policies, and under the framework of one city, one policy. So it was not unified policy measures from top down, and this time it's different. So obviously, from these measures, we do expect that near-term contracted sales will be boosted. There will be a rebound because previously lease demands were suppressed, and now it's been released, and they will be met in the market. But the question always comes down to sustainability, and from our negative view, you can tell that our view is that we don't think this policy impact will last. We think it will fade away after a few months, because as I said, we think China's economy recovery still faces multiple challenges. So a sustained or rebound, will not happen until
So what
we
about
see
when it comes to default risks then, Kelly? I mean, is that much higher now despite the policy easing we've seen?
Well, I think that's there's a positive elements from the policy supports, but but there's also against that there's still declining contracted sales. From issuer or developers' perspective, especially the weak ones, the privately owned ones, they continue to face declining contracted sales. They continue to face very limited, very constrained funding access, and when they have a lot of debt fall due, and that will create mounting pressure on their liquidity, and therefore increase their liquidity risk or default risks. So we consider we continue we continue to expect there will be more defaults coming this year, although it will not be as much as we've seen last year.